Let's understand how mutual fund works. You can imagine mutual fund as a professional investment manager who collects money from interested investors and invests it on their behalf. The funds from investors are usually brought in by mutual fund distributors. The distributors get commission from the mutual funds on the investment they bring in. Many brokerage houses, financial advisors, and banks act as distributors. They connect investors with mutual funds and help them to invest. Investment managers, advisors, and distributors render services, and it is legitimate that they get paid for their services. To a layman, it may appear that there are no fees levied on mutual fund investments, as they don't make any payments to distributors or advisors. Distributors receive commission from mutual funds. It is paid from the fees that the funds charge to investors. We will later see how this management fee is embedded in a mutual fund price. A mutual fund scheme gets money from many investors. Total amount in such a scheme may go up to thousands of crores. We will go through a simple example to understand how a typical mutual fund scheme works. Mutual fund houses like Birla Sun Life, DSP, BlackRock, etc. have many mutual fund schemes. One may invest in some of these schemes based on the investment objectives. We will look at how one may select fund for investment at a later stage. Let's get back to understanding how a mutual fund scheme works. Let's say a new mutual fund scheme is launched that will be investing in equity of new age biotech companies. When such a scheme is announced, it is called an NFO or new fund offer. This is the initial investment collection period before the scheme starts investing in specified type of assets, which is equity of biotech companies in our example. If the fund places a limit on the maximum amount of funds it would accept from investors, then it is called a closed-ended fund. If it does not place such limits, then it is an open-ended fund. We will understand open and closed-ended funds in detail little later. Assume that this is an open-ended fund and it is able to get 100 crore of funds coming from large number of investors in the initial phase, that is during its NFO. However, to demonstrate the case, we will assume that there are just 4 investors. Investor A has invested 10 crore. Investor B has invested 20 crore. Investor C has invested 30 crore. And investor D has invested 40 crore, amounting to total of 100 crores. Let's say that the fund has created a unit of rupees 10 each. This means every 10 rupees invested during the NFO will get you 1 unit of this scheme. For 100 crore investment, the fund will create 10 crore equal units. Thus, the 100 crore rupee will be invested through 10 crore units of rupees 10 each. Investor A will get 1 crore units, B 2 crore units, C 3 crore, and D will get 4 crore units. We will set this up on a spreadsheet.